Good morning and welcome to this Wednesday, November 24th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. First, want to wish everybody a restful and safe holiday weekend. If you're not familiar, we do have the Thanksgiving holiday here in the U.S. Tomorrow, Thursday, and Friday will be an abbreviated session. So Friday, we'll see the stock market open as usual at 9:30 a.m. Eastern, but it will close at 1 p.m. Eastern instead of 4 p.m. Eastern. So a much more abbreviated session on Friday. Our schedule here at Earnings Beats will be, as you might expect, probably not going to do a whole lot. Thursday, obviously, will be closed. Friday, we'll have we'll be around and be available. We're just not going to be working full time throughout the day. I probably will send out something on Friday to our members in the morning about the market, just a brief daily market report, but I wouldn't be expecting too much. Just probably not going to be spending a whole lot of time looking at the market on Friday. And Friday tends to be a very light volume day and normally not a whole lot of volatility. So I don't know. It kind of seems to me like on Fridays, if we open up a little bit, we just kind of stay up. And then if we open down a little bit, we kind of stay there. I just don't recall Fridays being having a whole lot of volatility, at least not normally. Anyway, futures this morning. Let's see. I know they were down earlier. Let's see. Well, one thing I like to do is just pull up on stock charts, go to symbol summary. You can pull up the ETFs that track the various indices. QQQ right now is down 0.6%. So it looks like NASDAQ get off to a pretty rough start. Spider down about 0.4%. And that tracks the S&P 500. And then, of course, the diamonds, the DIA, which tracks the Dow Jones, down almost 0.5%. So it certainly looks like we're going to get off to a rougher start. Small caps down about 0.7%. Mid caps down roughly about 0.6%. So across the board, looks like we're going to see a little bit of a sell-off at the open. Market's been consolidating, so I'm not too surprised. I think we'll probably see a little bit more drifting. But I'm beginning to think, if the market holds up here today, that will probably be okay. I think we'll hold the 20-day. That's just kind of my gut feeling at this point. I think we'll hold the 20-day, maybe make a new high in early December. But you should circle your calendar right now for December 10th, which is the November CPI release date. And then November PPI comes out on December 14th. Those are two dates I would watch. And I think, if the numbers come in hot again, with interest rates now back on the move, that could be something that triggers the yield to go above 175 and could be, at least a short-term issue for growth stocks. Maybe we're already into a little phase here where the growth stocks haven't been very good last couple of days. So maybe we're seeing that rotation now. But if we do rally one more time, I just wouldn't fall asleep at the wheel. December 10th, December 14th, a couple of big inflation reports I think we need to keep on the back burner there, at least know that they're coming. For those of you that are new to Earnings Beats, got a couple of things for you. First, I'm going to show you my screen here and we'll take a look at the website, but I'm also going to talk a little bit about our service just a little bit later in today's show. We are getting ready for the holiday. We got a fall special running. So I figured it'd be a good time maybe to spend just a little bit of time for those of you maybe who are non-members or are thinking about joining, just to tell you a little bit about what we do, kind of walk you through some of our products and that sort of thing. But before we get into any of that, just want you to know you can start a free trial, 30 days. You'll have to give a credit card because we have to get you set up in our system, but there'll be no cost for 30 days. And we remind our trial members before they expire that they're about to expire. We don't just, we don't sit back quiet and just let the monthly cost kick in. We'll let you know. If you want to be a member, we want you to be a member. If you don't want to be a member, we certainly don't want to charge you for that. But you can check out our no-cost trial by clicking on that button there. Our fall special getting ready to close. We only have 3 more days now through Saturday. This has been a great response. I want to thank all of our members for all of the support and the confidence that you all have in us here at Earnings Beats. You asked us in the past for extended periods to save more money, and that's what we came up with for this fall special. I think this is the best special we've ever offered. 1 year, which is typical. This is what we've done in prior specials. 1 year, you get your 2 bonus months, but we added 2 and 3 year plans where if you sign up for 2 years, you get 6 bonus months. So you'll get 4 bonus months in that second year. You still get the 2 for the first year, but then you'll get 4 for the second year. And then if you want to sign up for 3 years, we'll give you an entire year free. So that is clearly the best offer that we have. Great time to sign up and try us out for a few days and just kind of see if you think it's a fit. And then if it is, you got the fall special through Saturday to help save you some money. All right, going back to the home page and talk about this a little bit later as well. But if you scroll down, you'll see we have a free Earnings Beats Digest newsletter. Simply type in your name, email address, hit that subscribe button. No credit card required on this one. You can unsubscribe at any time. Mondays, Wednesdays, and Fridays, that's when we publish it. It's a very quick read, a couple of paragraphs and a chart usually. And, it could be a trading opportunity if you're so inclined. But for the most part, it's just an educational piece that we try to provide. And then we'll talk a little bit more in a bit, but these are our portfolios. You can click there to get some history on how our portfolios have performed versus the S&P 500 since their inceptions and in the current quarter. But we'll get to all that in just a bit. Let me move on to the daily market recap. Let's take a look at what happened on Tuesday. It could have been a lot worse. Our indices were much worse off during the day than where they finished. The Dow Jones Industrial Average up 195 points, S&P 500 up 8. The NASDAQ, which was down 200 points at one point, finished down 80, which is still down, pretty significantly, but well off the earlier lows. Mid caps down only 2 points. Small caps actually came back and finished up on the session after being down earlier in the day. So all in all, not bad action considering where we were intraday. Energy was the leader on Tuesday, gaining more than 3%. Crude oil has been bouncing back. You can see we got down to that 50-day test. Now we're starting to turn back up. You see the PPO down at the center line trying to turn back up. A breakout above 59.60 would be awesome for energy. I mean, if you're an energy fan. And I do believe on an absolute basis, energy is going to go higher. I just don't believe that's going to be the leader as we go into 2022 and throughout 2022. But that's just my opinion. That's based on the fact I believe the dollar will strengthen. And that normally puts a lid on the relative strength of energy and materials. Anyhow, energy had a great day on Tuesday. Financials also up more than 1.5%. Finally, we got that yield moving up. Financials tracking the yield back to the upside. Trend line being tested right now, though, you can see over the last 4 weeks or so. So just a little bit more of a move today to the upside could break that. And ultimately, a close above 41 is what we're looking for there. Real estate also a good day, up more than 1%. It's just sideways consolidating. So you got a nice little flagpole and a flag. So we got a bull flag here, breakout above 49 would be bullish. Staples up almost 2/3 of 1%, trying to break out after holding its 20-day moving average. I think things look pretty good here on an absolute basis. Worst performer yesterday was discretionary. And discretionary stocks like the S&P 500 right now, the reason I'm a little bit concerned is that we do have negative divergence. You can see the PPO lower, even though we've got higher price action. I looked at this more closely. I don't know that we got a higher close. And PPOs are based on closing prices. So I don't know if technically we have a negative divergence on the XLY. Maybe we can take a look at that in just a couple of seconds. But either way, I mean, we have a false breakout and you can see the PPOs lower. So I don't know, it might just be semantics here. But anyway, the XLY not so good on Tuesday. Technology, communication services, the other two aggressive groups also finished down. And that's the reason we saw the underperformance on the NASDAQ on Tuesday. Moving on to the 10-year Treasury yield, let me get the latest here. Currently, we're up at about 1.69%. We're up another 2 basis points. We had a string of economic reports out earlier, and we got more coming up later this morning. But let me walk you through those quickly. October durable goods fell 0.5%. The market was expecting them to rise 0.3%. I can tell you, though, durable goods can be all over the place. So it's very volatile. They tend to miss or beat by a lot, and then it can go the other way the next month. You really, if you're looking at this, I think better option is to smooth it out over a few months. October durable goods, if we strip out the transports, actually hit the target, 0.5% rise. So it was really the miss that occurred had to do with the transports. Q3 GDP, we got our second estimate. The estimate was 2.1%. That's exactly where we came in. Initial jobless claims was a shocker this morning. 264,000 was the estimate. Came in at 199,000, way below the estimate. So that showing a much stronger job market. October new home sales will be out later this morning. The estimate there, 790,000. September was 800,000. So just a slight downtick is what we're expecting there. October personal income expected to rise 0.2%. September was down 1%. So big rebound expected in personal income. October personal spending expected to rise 1%. September rose 0.6%. So while incomes may not be going up, spending certainly is. So consumer certainly keeping the market alive, keeping the GDP up where it is, and certainly doesn't look like we're going to be slowing down anytime soon. November consumer sentiment, 66.9 is the estimate. October was 66.8. So just a slight tick up there. And then later today at 2 o'clock, the FOMC minutes come out. So pretty full slate as we get ready for this holiday weekend. Moving on to, and I guess before we do move on to talking technically, I'm watching the 10-year Treasury yield as it moves up here. I wouldn't be surprised to see 175. I think, with the economic strength that we've been seeing, I expect yields to go up. I just don't think they're going to go shooting higher. So I think we go up, we test this 175 level. And I think the reason I talked earlier about marking your calendar for December 10th and the 14th, if that CPI number comes out on the 10th hotter than expected, and we go above 175 on that news, I think in the short term, that could be a problem for the growth stocks. So just throwing it out there. And the market anticipates. So if the market anticipates that we're going to have a hot inflation report, we could see the growth stocks, which already have struggled the last couple of days, we could see some further struggling there in the short term. Longer term, just like I said back February to May, short term growth stocks were getting hit. I felt comfortable that they were going to come back. They have come back. I would say the same thing again. If we do see weakness in growth stocks, I believe the economy's strong. I think we're going to continue to grow. And so I see these growth stocks coming back and leading the market again as we move into 2022. I do see some storm clouds in 2022. Going to kind of keep an eye on things for a while, but I'll talk a little bit more in depth about that at the Market Vision event that we do, Market Vision 2022. We've had, our last two, Market Vision 2020 and Market Vision 2021, we held in January each of the last 2 years. And I was pretty bullish going into both those years, and I'm still bullish, but I just think it's going to be a choppier, it's going to be a more volatile ride, I believe, in 2022. So we'll talk more about that. Anyway, let's move on. Talking technically, the S&P 500. There is your false breakout right there a couple of days ago in the DMR on Monday when it was reversing. Actually, I think it was maybe flat at the time. Or maybe it was just about where it had opened. But I said if we finished weak, that could lead to some more weakness near term. Well, look at what happened. We went down, tested that 20-day EMA on the S&P 500 before rallying. So the good news is so far we're bouncing off that 20-day. The bad news is if we don't hold it with that divergence looking the way it is, we could see some additional weakness. I believe we're going to hold it. And, we don't have a whole lot of room to the downside. We're at 46.90. If we drop 0.5% at the open, that would be 23 points. That would take us to 46.67. And our 20 days at 46.49. So we don't have a whole lot of room to the downside before things could get more interesting. But I still believe that even in the short term, if we do pull back, I think it's an opportunity. I expect that we're going to see a bounce back in not only in U.S. equities, but I think the growth stocks will continue to perform well. All right. I wanted to also pull up the XLY. I think the XLY, you can see right there, there's the higher price. Let me see if there was a higher close. I know it's close. So technically, you don't have a negative divergence unless you have a higher closing price, not higher intraday. You can see we have a higher intraday. It's pretty easy to see. But did we have a higher close? The reason you look at the close is because PPOs are based on the closing price. So this right here, this top would be based on this closing price. And all of these are going to be based on these closing prices. So anyway, the close back on November 5th was at 211.26. The close, okay, November 19th was 211.42. So it was slightly higher. But yesterday, when we had the intraday move to 215, we actually closed at 210.89. So this close was actually lower. So sometimes the candlesticks throw you off when you're looking at divergences. And that's why I've said in the past, you know, there's only a couple of times I'll use line charts. One is when I'm using a price relative. So if I'm looking at something like the XLY, XLP, if you look at this on a candlestick chart, it's just really a lot of noise. I just want to know, is it going up or is it going down? And I can't really tell where it's closing with all these candles. So that's why I would use, instead of candlesticks, I would use a solid line chart. And to me, this is just much easier to read quickly to see what's going on here. Here, you know, we're going higher. We do have a negative divergence on this relative chart. Haven't really paid much attention to that in the past, but you know, it's probably no different than any other price chart. It shows us that things are slowing momentum-wise. So maybe we are poised for a little bit more weakness, or at least sideways consolidation for a period of time. After all, we had a huge run up. I mean, from this August low all the way up to the high we just saw last week. That's a huge relative move in discretionary versus staple. So pulling back and consolidating for a period of time would not be a bad thing. Usually when it happens, I'll get a lot of questions about, oh, is this bad for the market? No, it's not bad for the market to pull back from time to time as long as you're in an uptrend. So, I mean, look at all this consolidation throughout almost all of 2021. Market kept going higher, but we weren't breaking out. That wasn't necessarily a bad thing. We were just consolidating after a huge move up in the prior year. You know, if you go back 2 years, you can see we had this huge move up. Going sideways for a while isn't bad. It's just consolidation. Now we're breaking out, we're trending higher, but pulling back, I mean, even back to about the 265 level, that's kind of where all these tops were coming in. So we could pull back quite a bit and I'd still feel fine about this ratio. But anyway, getting back to my point about line charts, the one thing I like to use these line charts for is the price relative. And then the other thing I like to use it for is to see if we have a negative divergence. So for instance, here, what I could do, it's hard to see with the candlestick, but if I pull up the line chart, and this is so close, it might be hard anyway, but we actually did go slightly above right here with a lower PPO. So the line chart gives you closing prices only. So it takes out all that noise from the candlesticks. I like that noise generally. You know, I want to know what's going on in the market and where we were intraday. And I like the visualization of the candlesticks. But for purposes of trying to decide whether or not you have a positive or negative divergence, line charts are best. All right, so let's talk a little bit about earnings beats. So for those of you who maybe have been listening to the show, obviously, you know, this is one of the free things that we do for the community. We have a Trading Places live show here at Earnings Beats that you can listen to on Mondays and Wednesdays, starting at 9 a.m. Eastern. All you have to do is literally come into Earnings Beats and just click on Trading Places Live. Usually by about 8:45, we have a link set up on that page where you can come right into the room. So that's, you know, first step. Second step, let me see, come back over here for a second. So second step would be Stock Charts TV. So on Tuesdays and Thursdays, I do the same show, but I do it for Stock Charts TV. So they air it at 9 a.m. Eastern. Currently, that's a recorded show. Hopefully that'll be changing in 2022. It'll go live. Maybe even, you know, with pictures, you know, you'll be able to see me and everything else. Not that that will be any treat. But I know that's the way they're doing the final bar right now. And I think their goal is to do that with other shows as well. But for now, I'm sending them a recording and they air it at 9 a.m. Eastern. Then they play recorded versions throughout the day. But you can check out that. So those are both live shows, and or they're both free shows. The Earnings Beats right now is live. The Stock Charts is recorded. But you can check those out. One other thing you can do is go to the articles. I have free articles that I publish, a number of them. So if you go, there are 3 different places you can go. If you go down to the Stock Charts blogs first, you can go to Trading Places. This is the blog I post in most often. You can see the here, November 18th. So it's been almost a week since I posted, but here, normally I would say maybe twice a week is what I would expect. If you're not familiar though, if you go into any of these articles, mine or anyone else's at Stock Charts, if you go all the way down to the bottom of the article below where I sign off, there's a place where you can put your email address in and hit the subscribe button. Completely free, no credit card or anything. All this does for you is anytime I publish my article, because I do publish articles randomly over there, if I do publish, it'll be sent to your email. So you don't have to keep coming over to Stock Charts to check to see if I've published something. As soon as I hit that publish button and publish it at Stock Charts, it'll be emailed to you. So that's a pretty cool feature. So that's one blog that I think is worth checking out. Another is the Chart Watchers. This is a free newsletter that goes out every Saturday morning at Stock Charts. So I'm one of the featured authors there, as is John Hopkins, my partner. We alternate weeks. So I'll do it one week, he'll do it the next. But Earnings Beats is represented in each of these Chart Watchers articles. But if you go in here, you can hit this, you can go hit the blog archives on any of these. You can go back and look at some old articles. But if you scroll down, here's John's article from last week. If you scroll down further, here was my last Chart Watchers article. These are free. And again, you can go down and scroll down to the bottom and subscribe to these to make sure that you get them when they've been published. And then the final one, I don't publish in here as often. I want to try to get back into this and try to do this more often, but I was trying to do it every week. So here, the 15th, I did one. Here on the 4th, I did one. The 29th, I did one. But this is usually a much a quicker read and just one chart normally. So you can see just the one chart in the paragraph and then boom, done. So you can check that out. All of these are free. So, we do try to give a lot of free information as well as our paid information, but I think our best information, our most timely information, no doubt goes out to our members. So here, this is the daily market report. So we do 3 things really at Earnings Beats. First is guidance. I think of our platform as a guidance, research, and education platform. So we really have 3 different pillars of our business. The guidance part to me is our daily market report. So every day that the stock market's open, with very, very few exceptions, I will write a report normally during the day, usually in the afternoon. Some people have asked me, why don't you do it in the morning, do it earlier? I like to do it in the afternoon because I like to see what's going on during the day. I like to see how the market's trading. So usually I will publish it. I mean, in a perfect world, I would normally publish it between 2 and 3 in the afternoon. Sometimes I'll go to 3:30. I try not to post it past 3:30. And sometimes our mail server isn't working great, or there are clogs in the internet around the world. I mean, I don't know how all that works. But in addition to sending out the daily market report to all of our members, we also publish it on our website. So if you come into the website and you just click under here, under stocks, the daily market report, you can get it. So in other words, if 3:30 rolls around and you haven't seen the daily market report, you might want to come in here and click on it and just see if it's in here, and maybe the mail's just having a problem. So you can definitely check this out. But in here, we normally give some announcements, but then a very quick executive summary as to what I'm seeing in the market, some of the news events, maybe some of the earnings reports. Zoom video was in the report I sent out yesterday because that was taking a big hit. Then I go into the market outlook, try and explain some things that I think driving the market. Talked a little bit about the VIX yesterday and how that might be impacting the S&P 500. Then go into sector industry focus. So yesterday I talked about software, the negative divergence, the fact that we're getting hit, showed some support levels. And then using our chart list and trading strategies, we try to go through and point out a couple of stocks maybe that you might be interested in based on the current market environment. Then I go through, summarize some key earnings reports that'll be released that day and the next day, and then wrap it up with an economic report feature. So we talk about any economic reports out that day. So it's a very, I think, when you go through it over the course of a month, you're getting a lot of charts and a lot of analysis. And I think I look at the market a little differently than most people. It's not just here's the S&P 500, but it's a lot of intermarket work that I do. And you're going to find all of that in the daily market report. So that's, in my opinion, step one at earnings beats. I think, if you ask me, okay, what's the biggest thing that we do, or what's the biggest feature? I think it's the daily market report. I normally spend a couple of hours doing it every day. I usually am looking at a number of charts, and I just try to find some things I think are of interest without beating a dead horse. I try not to put the same S&P 500 chart on every day. So anyway, you can check that out. Now, as far as our research, I think our research, and by the way, we have other reports. I don't have time to go through all of them, but you got the portfolio report. We've got a seasonality report, a short squeeze report. All of this is kind of guidance and research all at the same time. But I look at our research as being our chart list. So under chart list, you can come down. We have a strong earnings chart list, which features all the companies in the last 2 to 3 months that have beaten Wall Street estimates, top and bottom line, revenues and earnings. They're liquid, and they also look good technically to me, or they're in groups that are technically sound. Then we have a relative strength industry group chart list, which we provide to our annual members, where you can see on a relative basis all 104 industry groups. Then we've got an accumulation distribution chart list. So this is a chart list where we feature companies that we believe, based on their accumulation distribution lines, they appear to be accumulated. So we have 288 companies on there right now. Then we have, I'm going to go down just to skip a little bit, but we have a strong future earnings chart list. So these are companies that look good technically, but are not on our strong earnings chart list. So Wall Street likes them, but for whatever reason, they haven't beaten Wall Street estimates recently. So we have that. We have a short squeeze chart list right now, 44 heavily shorted stocks. That changes every couple of weeks. We send that out to our members. Earnings AD chart list. This is a fairly new chart list that we came up with recently, where we're looking at companies after they report earnings from their opening price to their closing price. Do they go up? And if they do, we want to look at the ones that go up the most. So that's what's on here. 64 companies of the most heavily accumulated stocks based on their AD line after earnings. Raised guidance chart list. So we go back and we put together, we got now 398 companies on this chart list that have all raised guidance in just the past couple of months. So we've got our focus not only on the technical side of things, but also on the fundamental side of things. We combine. And then we do a seasonality chart list. Every month we do 20 companies that tend to perform really well during that month. So we have technical analysis, we have fundamental analysis, and then we also look historically at the market for a seasonality. And then we move on to education. I would throw our portfolio chart lists, webinar chart lists. To me, that's all educational, what we do from an educational purpose. We try to teach our members about relative strength. And that's what these portfolios are mostly about. The reason that they have outperformed over long periods of time, in my opinion, is because leading stocks do that. They lead. And so if you fill your portfolio with leading stocks, sure, some of them are going to fall out of favor. Some of them are overbought and they go through a period of consolidation, but there are also going to be a number of these stocks that continue to outperform and carry the portfolios. So this is where, if you look back here, I mentioned earlier, our history of success. You click on that and it'll go in and it'll show you our inception return since inception. And then the current quarter, which by the way, for us just started November 19th, which was last Friday at the close. So off to a rough start this week so far, but growth stocks, have not done well so far. And that's what you can expect. We're definitely growth oriented. All right, let's go over just a couple of earnings reports real quick. This is Autodesk, and actually market's getting ready to open. Let me just give you the Autodesk pre-market. It's down 13%, 41 bucks, even though they did beat on their estimates, $1.33 versus $1.25. I'll give you the real time. I'm going to go just a minute over, maybe a couple minutes over here. Vmware reported, they're not showing so far today's action. There we go. So it is up right now, 2.6%. They beat $1.72 versus $1.54. Dell also beat 237 versus 233. Stocks up fractionally, almost 1%. Hewlett Packard, HPQ, HP Inc., stock up almost 6%. They posted 94 cents versus 88. The gap, GPS, actually missed 27 cents versus 49 cents. And as you saw yesterday with Nordstrom's, this area, don't miss. And Gap missed, and you can see the stock down 21% today. Anaplan, this is a software company. They lost 5 cents versus 11 cents. Not good enough. And I'll just show you one other thing that I think is really important. Remember, software has been going crazy. Here's software. Here's Anaplan, which has been going sideways. We were down close to a 52-week low prior to coming out with earnings. So even though they beat, you can see what's happening. Wall Street tossing the company to the side. They come out and they beat, they go down 21% anyway. Pstg, Pure Storage, 22 cents versus 12 cents. Nice breakout here. I really like this breakout. This, if you look at it, is a breakout of a long-term consolidation period. So I'd keep this one on my radar. I think this one goes higher. For the three you must see, how about we just do 3 more earnings reports? So NTNX, they beat, lost 22 cents versus the expectation of a loss of 34 cents, but so far not good enough. Really needs to hold. I don't want to see it close below $32 right here. So let's see if we can hold 32 on NTNX. JWN, this is the one I was talking about, Nordstrom's. They came out, they missed 39 cents versus 56 cents, stock down 23%. So GPS and JWN battling it out for a horrible performer today. And then the last one I'll give you is Guess, which is an apparel retailer that beat 62 cents versus 46 cents, and it gapped up about 9.5%. So that is it. Let me give you a quick update on the market, see if we're selling off any more or what we're doing here. Yeah, NASDAQ down 143. So again, we're under pressure. S&P back down 27 points, only 14 points from that 20-day EMA. So if we fail to hold with negative divergences, that could lead to some additional short-term weakness. So keep all that in mind. Definitely is a little bit dicey right now in the near term. All right, that's it for me. I appreciate everybody tuning in. No Trading Places Live tomorrow because of the Thanksgiving Day holiday. So your next Trading Places Live will be on Monday, and it'll be right here at earningsbeats.com. Last thing, again, I just want to point out is on our homepage, don't forget, you can check out our service with a 30-day no-cost trial. And don't forget about our fall special, which does expire at midnight on Friday. Everybody have a great day. Enjoy your weekend, and hopefully enjoy it with family. Be safe, and see you next week. Happy trading.